Going to get back to the inflation read and inflation generally speaking out there. And Omar, give us a sense of where you are in this whole conversation.
Well, we think that inflation will be elevated for a while. Obviously, and the market is getting a lot into the semantics, I should say, of what's transitory, what's not. We think that essentially inflation will be elevated for this quarter, probably the next 2 quarters, and that's driven by a number of factors, including supply chain and monetary policy still being quite accommodative, commodity prices, and so on. And that will have an impact on monetary policy, is having an impact on monetary policy as well, as you can see in terms of the Fed tapering and some of the other central banks, such as Bank of Canada, Bank of England. We think that this will probably start to dissipate in the second half of next year.
So do you think even when it comes to Chinese bonds that traders are likely to kind of overlook this higher inflation print because the economy is slowing down in a big way and bonds are still very much more attractive than what we're seeing in the rest of the asset class right now?
Yeah, that's a very interesting question. Actually, specifically for China, we think that inflation will probably be more benign. And that's simply for a number of factors, such as the fact that the base effects that some of the, for lack of better terms, DM has, such as the US, Europe, Canada, and so on, the base effects are more pronounced there because of the way that the pandemic was held and the lockdowns and so on. And the fact that China, the consumption, as your previous guest was mentioning, is not, the consumption rebound is not as strong. So in terms of China specifically, we think that inflation generally will be benign. There's a divergence between PPI and CPI, and that's almost entirely driven by commodity prices.
Omar, just looking at how China used to, and this is something I go on about quite often, which is used to be responsible for exporting disinflation or even deflation around the world. Does this factory gate reading cause concern for you for global inflation, not just in the US?
I think what we're focusing a lot on is, in particular, the credit impulse out of China. And I think Bloomberg, you guys have a good indicator on the terminal on that. And we think that this is a key indicator to watch. The credit impulse does explain quite a bit in terms of the performance of market indicators in China. And it also has a large impact in terms of economic growth, the industrial output. And this is what we think propagates the most, particularly in terms of some EM and also in terms of some PM in terms of global growth. This is what we've been focusing on. This has been negative, actually, for the past few months, even years. And we'll need to see how it evolves, particularly in light of the Chinese real estate major turbulence that we're seeing in the market.
Yeah, I was going to ask you, have we seen this bond market sell off when it comes to high yield? It's spread to investment grade, even hitting companies that are very high rated, like Tencent and the banks, the like. Today, we're seeing some of these junk bonds still set for the biggest jump in 3 weeks, Omar. So we're still seeing a bit of reprieve, at least today. But how far do you think this can go in terms of where junk bond yields can go? We're already at above 20%. And at what point do we expect China to put a floor on it?
So the latter part of your question is key in terms of policy support. And we think that this turbulence can continue for a while, and that market is probably scarred because of the fact that we think that policy support, Chinese policy support specifically for that segment and specifically the high yield real estate developers will be rather timid. It will not be non-existent, but it will be timid. And this is part of the broader theme that we're seeing this year playing out, which is not entirely priced in, by the way, in the market, which is the less sovereign support in terms of, or at least less forthcoming Chinese sovereign support to the market. So that market is yet to find the floor, and it's entering a rather alarming phase, which is when bond prices in the high yield segment trade where they are, the willingness to repay might start to wobble because certain Chinese developers or some companies will wonder why they need to repay if their bonds are trading where they are. However, I would say two things. One is the impact, even though it has radiated a little bit to the broader segment, but little bit is the operating word here. It remains localized in the high yield segment, specifically in China. And two, in terms of the risk or systemic risk, particularly to the Chinese financial system, after we've done some scenario analysis and so on, we think it's rather limited.
Omar, just talking about risk reward, where do you find safety and where do you find juice?
Okay, the short answer to the juice is you find a lot of juice in terms of the high yield segment. And the issue is really to be able to withstand turbulence. We think that there will be winners, including in the Chinese real estate segment. So fundamental research here is very important. And we think on the other side of this, there will be significant winners. And we think that it's if one can withstand the turbulence, it's potentially good to start dipping one's toes in that market. In terms of the safety, to answer the second.
Yeah, go ahead first. Finish your thought.
In terms of safety, we think that broadly the market, particularly on the investment grade segment, has remained relatively spared from this. It's a market that's very well anchored. We continue to see flows into that market. And it provides a bit of a yield differential versus some other markets. So the Asia IG market does continue to be interesting in our view. And in terms of the high yield segment, one has to withstand turbulence, but there's a lot of opportunities there.
I was just looking at what this kind of bond buying fury that we saw overnight. It seems like, maybe Omar, you can give us a little bit more on whether this is just a short covering that we're seeing, given just how underweight the market has been, or is there some kind of fundamental move? And on the back of it, you also have, when it comes to tips, the 10-year yield are hitting record lows and further negative territory. What does that all spell to you?
Specifically on the move that we've seen in the past few days, I think it is related to the chair selection, the Fed chair selection. I think there's a bit of talk in terms of whether it will be Powell or it will be Brainard, and there's a perception that Brainard might be a bit more dovish, even though I think that at the end of the day, monetary policy, regardless of who is picked, will be, there could be some nuances here and there, but broadly it will be relatively the same. On the regulation side, it is quite different, but the focal point of the market is really the monetary policy. But in terms of the broader kind of market, in terms of the broader market dominating theme in terms of the treasuries, it's that kind of tug of war between whether inflationary will be persistent or not, and where the terminal rate will be, and where the terminal rate will be. Looking through essentially what will happen in terms of the Fed is anchoring the overall yield curve, and that's having an impact.